Happy Monday, everybody. All right, today I want to review a powerful but often overlooked economic indicator, and that's the gold copper ratio. And as the name suggests, it's the ratio of the price of gold to the price of copper. Now, before we go into that actual ratio, let's look at the two metals involved in that and why we're comparing the two. We're comparing them because they're kind of opposites in terms of their use. So why do we use gold? Well, besides jewelry, we don't use it for much. A little bit of technology, but for the most part, it just sits there and collects dust, which is why it's valuable in itself because it doesn't deteriorate, it doesn't break down. You throw it in the ocean, it remains the same, always has. So when wealth is leaving other asset groups moving into gold, it's because of economic uncertainty, potential fear, economic crises, and that's when you see the price of gold moving up. What about copper? Well, copper is the opposite. It's industrial. We used to use copper for pipes and plumbing, no longer. It's too valuable for that. Now we use it for technology. So when you see the price of copper going up, it's because you've got homes being built, buildings being built, data centers being built, computers, phones, all every technology you can think of. It's how we transmit uh, electricity after it's generated. So it's essential to the modern world. So when you see the price of copper going up, your economy is going and blowing, and things are great. All right, so now let's look at the price of those two metals together. If you've got a high ratio where the price of gold is low compared to the price and the price of copper is high compared to that price of gold, that means money's not flowing into gold. So that means that there's not concern for economic uncertainty. And when it's not flowing into gold, but is flowing into the copper, the demand pushes the price of copper up because your economy is booming. You're going and you're blowing. Well, today, that's not where our ratio is. In fact, our ratio is the opposite. The price of gold to the price of copper is about as low as it's ever been. In fact, that ratio is lower than it was during the great financial crisis of '08. And that was a really tough time. All right. So, but now let's look at the prices of gold and copper. If you look at gold, if you're one of our clients, you've seen the price of copper go up quite nicely. In fact, over the last 12 months, it's up almost 10%. That's great. Also, actually, even over the last month, before I move on to gold, even over the last month, it's up over 1%. So, really, in any kind of by any analysis, that would be a good return. But compared to the price of gold, gold is up over 40% over the last 12 months. So that ratio now is the highest it's ever been, but that's with growing demand in copper. So what's pushing the current demand? Well, our current technological needs. I mean, we're barely keeping enough electricity going to keep air conditioning running in California and Texas these days. And so then you start adding on uh, AI data centers. You start adding in more and more blockchain. Takes a lot of computer power. You throw in quantum computing. Yeah, we're not pulling copper out of the ground fast enough to where we're using it. So actually, that economic indicator is saying that yeah, actually the price of copper is going up. That means that the economy it's not at a standstill, but it's moving forward, but not even close where it comes to where's the money flowing. Obviously, the money's flowing into gold, and like we've talked about before, it's not from the perspective of individual day-to-day investors, at least not when you're looking at 401k portfolio holdings. When you look at those holdings, it's less than 1% of portfolios. Where's the demand coming from? From central banks. Why are they doing that? Well, they're shedding US treasuries, they're shedding euro treasuries. And to Greg's point from his video, you've got the mess in France right now. You understand why central banks aren't stocking up on euro holdings or French holdings. Money's not flowing into Chinese debt because we don't know what we can trust coming out of there. Where is it flowing? Gold, including China. China's storing up gold as fast as anybody is. and central banks around the world, they're pushing the price of gold up. So stick with me here. The price of copper is going up, but not even close to the price of gold, which makes that ratio as low as it's ever been, lower than it was during the great financial crisis. In fact, the only time it's been lower is in recent history, and that was during COVID when the world shut down. There was no economic activity because everybody was locked in their homes. That would explain why the use of copper was shut down. So, what does this mean? Well, just on the surface, it means what we already know, that gold is pushing up the price of gold. But what we need to pay attention to is that it's pushing it up faster than the price of copper is keeping up, even though copper is in greater demand right now, but it's not going where the gold is going or in terms of price. So as Greg said, when we were screaming last year that, hey, these numbers with jobs, there's no way they're that rosy. Turns out we were right. Well, a recession may have already started. Well, that would help explain this ratio for sure. The other thing is that this ratio is just a ratio. It doesn't make predictions. It just explains what's going on. And right now it explains where money's flowing. So um, it's definitely an indicator that we're not in great economic times. If money's flowing into gold, it's because there's concern. Now, if you're a client of ours or been, following us for a while and own gold, silver, you're doing great. Actually, if you own copper, you're also doing well. However, this doesn't bode well for the economy at large, especially the economic factors of the economy. So the stock market, jobs. All right. Hope you found this interesting. If you did, leave me a comment and you all have a great week. Take care.